Welcome to the Mental Health Market Update, where we talk about what's happening in the mental health industry. Here's your host, Stephen Hayes.
Welcome back to the Stigma Podcast. Today's Mental Health Market Update is a deep dive into Teledoc. I've been really excited about doing this one. This is a very heavy analysis, and I'm going to put a detailed write-up of what I'm describing here today with charts, pictures, data, tables, analysis on the Stigma Podcast Patreon page. Yes, I am plugging Patreon early in today's episode, but I do want to make you aware that there's a detailed written analysis available. So why does Teledoc matter? Should it be trading at 20 times revenue? Should it be trading at 200 times its EBITDA? Let's dig in. So this matters to me because the future of care delivery rests somewhere between pre-COVID telehealth adoption and mid-COVID telehealth adoption, the way I think about it. Teladoc's stock price, their estimates, the performance, investor sentiment, strategic decisions, etc., can telegraph a lot of what's going to happen around virtual care delivery, and that can be leveraged to gain insights into how a startup could and should be positioning for the future of telehealth. So let's dig into the company. Teledoc is the market's largest provider of virtual healthcare services. In 2019, the company generated $553 million of revenue and $32 million of EBITDA with a margin of 5.8% and revenue growth year over year compared to 2018 of 32% revenue growth. Analysts are projecting 2020 revenue at $821 million, representing year-over-year growth of 48%, with a huge boost from new users and the explosion of telehealth in light of current market conditions. As of early March 2020, the company had over 2,400 worldwide employees, serviced over 450 medical subspecialties, has providers that speak more than 40 languages in 175 countries, and leverages more than 50,000 clinicians globally. Their scale is staggering. The core product offering is a virtual replacement of low acuity in-person doctor office visits, including urgent care and emergency room visits. They replace these in-person visits with a virtual live video or phone consult with a doctor. Teledoc conducts these virtual visits through their network of thousands of board-certified physicians. These services are on demand, and the average wait time for a consult is about 10 minutes. It's really less than 10 minutes. A large majority of the medical issues that people come to Teledoc for help with are sorted out in one consultation with an out-of-pocket price of $49 or less, depending on which plan that user is on. I'd consider Teledoc to be a best-in-breed business coupled with a first-mover advantage in the telehealth space. And it's not just me that thinks that. In a June 24th survey conducted by JP Morgan Equity Research, they polled HR executives at some of the largest corporations in the United States about telehealth within their benefits packages. And in that survey, they found that 96% of these employers already offered telehealth as part of their benefits package before COVID. Of that group, Teledoc is the most frequent, with about 40% of the respondents saying their plan included access to Teledoc. The second most common name mentioned was MD Live, with 26% penetration. These HR managers were asked to rank happiness with their telehealth platform on a scale of 1 to 5, with 5 being very unhappy. Teledoc ranked number 1 with a 1.83 rating, so low is better, like in golf, which isn't bad, but there's certainly some people in that group that don't think it's great, but we'll dig into that in a little bit. All of that to say, Teledoc is the market leader, not just by way of size, but by user preference and sentiment as well. I want to dig into their products and services real quick. I'm a little bit surprised, to be honest, at how many people have heard of Teledoc, but actually can't describe accurately what they do. So I'm going to summarize their core product offering as briefly as I can. The way I read it, Teledoc offers 6 core products. This includes 5 consumer brands and then another business unit or product where they license their platform to hospitals and health systems via a handful of different licensing agreement structures. Product number 1 is just good old-fashioned Teledoc. This is their core telehealth offering. This is where payers buy access to the platform for their members by paying a monthly subscription access fee. When the members want to use the service, they request a visit through Teledoc's website, app, or call center. Teledoc software then matches the member with an available physician based on a variety of metrics. The average visit begins in about 10 minutes after the initial request is made, and the member is usually paying a $49 per visit fee for general medical visits, with specialists charging a little bit more than that, but sometimes that $49 fee is covered by a member's employer or their insurer. The doctors are independent contractors. They're kind of like Uber drivers who are able to practice on their own schedule with very little to no time commitment required. Teledoc handles malpractice insurance, coverage, billing, admin, and a bunch of other back office services. and doctors are paid on a per meeting basis for visits that last about 10 to 15 minutes, where the doctor makes around $25 per visit as a starting fee for general medical visits, and that increases as you start to add in complexity and specialty. Product number 2 is BetterHealth, Teladoc's direct-to-consumer behavioral health business. Unlike the telehealth offering, instead of a member being assigned a physician, the system generates a list of potential therapists based on response to a short questionnaire, and appointments are scheduled ahead of time, usually within about 48 hours, and the member sees the same therapist each time. These members pay about $40 to $70 weekly for this service. Product 3 is called Best Doctors. This is Teladoc's second opinion service, which is used for higher acuity situations as opposed to the core telehealth service, which is better suited for low acuity conditions. In the event a member receives a particularly complex or serious diagnosis, they can request an expert second opinion through Best Doctors. Teladoc's network of top medical experts reviews the member's case file and then either confirms or modifies the diagnosis and treatment plan. In many cases, the recommendations of the experts are different from what was initially proposed. This happens in about 37% of diagnoses and about 69% of the treatment plans. This improved accuracy offered by the second opinion saves insurers significant amounts of money. Product number 4 is called Healthiest You. This is Teladoc's consumer engagement platform, which not only helps drive awareness and utilization of its services, but also serves as an important competitive differentiator for the company. The July 2016 acquisition of Healthiest You helped modernize and supercharge what had historically been a very print-heavy, they mailed welcome kits and postcards, a very print-heavy member outreach. The addition of Healthiest You paved the way for Teladoc's current consumer engagement strategy, which uses a multifaceted and much more digital-heavy approach to driving utilization. Product number 5 is called Advanced Medical. Advanced Medical was acquired in June of 2018 and significantly expanded Teladoc's global footprint, adding offices in Spain, Hungary, Portugal, Chile, Brazil, UK, and China. Similar to Best Doctors, Advanced Medical was primarily an expert second opinion provider. It had also built out other virtual clinical capabilities, including chronic care management, medication support, and clinical risk assessment, as well as general medical telehealth. And that brings me to product number 6, which is the licensing business to health systems and hospitals. So beyond the consumer brands, Teledoc offers its platform to providers who can white label and customize or configure it as they please for use as a backbone in their own telehealth service. This is the fastest growing of Teledoc services, as more providers are looking to stand up their own service, either as a way to provide individuals more convenient access to their systems or as a more defensive measure to help mitigate leakage of patients to other health systems and other telehealth providers. So that's the product offering. Who pays Teledoc? Mostly insurance companies and self-insured employers, but Teledoc also gets paid by providers in hospitals, like I mentioned in product number 6 a moment ago. And there's also a direct consumer portion of the business as well. The majority of its payer clients, meaning insurance companies and employers, pay a recurring per member per month subscription fee for access to the platform. And in most cases, there's a per visit fee that's associated with each consultation. Okay, so let's dig into the revenue model. In 2015, the year of the Teledoc IPO, they did $77 million of revenue and grew to $123 million in 2016, then to $233 million in 2017, and have continued growing at an annual CAGR of 55% since 2015 until 2019, in which year annual revenue reached $553 million, as we mentioned at the beginning. As of today, the midpoint of the company's guidance for 2020 revenue is just over $700 million for the year, and they've indicated that growth won't slow down anytime soon as they've continued to add new clinical services, new payment models, and provide care in ever more care settings. So how do they get paid? Well, there's actually several ways. Recurring subscription access fees, or SAFs, contributed to about 85% of total revenue over the last 12 months. Visit fees counted for the rest. There are a handful of ways Teledoc is paid by its clients that vary based on the type of service offering and the type of client. There's 4 that I'll cover here. Number 1 is per employee per month, or PEPM. This is the most common revenue type for Teledoc. This is when a client pays for a per employee per month subscription access fee to Teledoc, which gives members access to the service, and then Teledoc adds on a visit fee each time a member uses the platform. PEPMs can range from 15 cents to several dollars depending on the size of the client. The average visit fee for a basic general health visit that's added on is $49, as mentioned before. Number 2 is PEPM only. And this setup involves a client paying a higher PEPM, which is sometimes up to $10 per person, but they get a certain number of visits included as part of that monthly fee. The company and the research analysts that cover it refer to these types of plans as all-you-can-eat contracts, which is a little bit misleading because the company adds a component to these contracts that allows Teledoc to adjust the pricing as utilization thresholds are breached, which enables Teledoc to protect its gross margins. Of note, about 20% of Teledoc's membership is covered under these all-you-can-eat or visits included arrangements. This type of model is typically preferred by small and medium-sized employers due to the visibility that it provides into future costs. Number 3 is visit fee only. Teledoc started letting some of its clients go to this model back in 2018, which was intended to align client savings with Teledoc's revenue objectives, giving Teledoc an incentive to increase utilization because Teledoc is only paid for completing a visit. This model includes much higher visit fees that are often in the $150 per visit range. And finally, number 4, providers. Teledoc provides its platform to other providers and hospitals and charges a license fee to do so, as well as tacking on a per visit royalty fee. The fee structure varies depending on whether or not the provider in question wants to leverage Teledoc's network of doctors or use their own doctors and just leverage Teledoc's technology. So that is the business at a very, very high level. Now let's dig into their growth. This is the exciting part. And actually, after this, we'll cover valuation, which is the really interesting part. Teledoc is a growth machine. These guys have been exploding for quite some time. Yes, lately because of COVID, but they've really been diverging from their peer group since about October of 2019 when it comes to valuation metrics. And we'll get into that in a minute. They have a very diversified growth strategy that has led Wall Street analysts to project 20 to 30% annual revenue growth out through at least 2023 on an organic basis. And that doesn't even include likely acquisitions, which Teledoc has displayed an appetite for doing a lot of M&A over the last 7 years. And we're going to get into that in just a minute. One key area of organic growth is what we call member growth. At the end of 2019, Teledoc covered 56 million lives with 36.7 US paid members and 19.3 million US members were on a fee-only access plan. The US paid population grew by 61% year over year in 2019, which was largely due to expansion of the UnitedHealth relationship, which added about 5 million US paid members in the fall of 2019. And when we look at when Teledoc's valuation multiple really diverged from its peer group, that is right about when it started to happen. In Q1 2020, Teledoc added another 6.3 million US paid members for year-over-year growth of 16%. And I expect that Teledoc will continue to have this kind of quarterly growth with new members for quite some time. I mentioned valuation a couple times above, and we will dig into it in detail later, but I wanted to make the point that if you look at this line chart that's going to be in the Patreon write-up of enterprise value to next 12-month revenue on a daily basis, in the past, Teledoc trades mostly in line with their healthcare IT peers. But in October of 2019, Teledoc started to trend above that group, and that gap has really expanded lately. The timing of that divergence coincides with what I mentioned above around the UnitedHealth relationship expanding significantly. So that brings me to what's driving the growth. A lot of this growth is driven by extensive relationships with UnitedHealth, CVS, and expansion of Medicare and Medicaid coverage. Teledoc got access to UnitedHealth as a customer by acquiring Healthiest You in 2016. Over the years, Teledoc has engaged with United on a number of initiatives, including a TRICARE pilot, a pilot with United's Medicaid population, then was later selected to be the platform provider for WellMed, an Optum solution in Texas and Florida, and a number of other initiatives. The relationship between United Healthcare and Teledoc runs deep, including the fact that United is a shareholder in Teledoc. The expanded relationship between Teledoc and United has been a huge source of growth for Teledoc and will continue to be so in the coming years. The CVS relationship is also huge for Teledoc. It started when CVS introduced telehealth at Minute Clinic in 2013, and then in 2015, CVS announced that it would work with American Well, Doctors on Demand, and Teledoc to provide direct-to-consumer telehealth solutions. In 2018, CVS and telehealth expanded their relationship by launching a CVS-branded telehealth offering through the CVS app powered by Teledoc. As of today, this has been rolled out in almost all 50 states. I think there are a few stragglers, but it's basically nationwide. One more massive source of growth for Teledoc is Medicare and Medicaid. Over the years 2018 and 2019, a lot of rules changed that increased provision of virtual visits for the Medicare population, mainly due to changes to the physical fee schedule during those years. But the big change that's really driving a lot of opportunity for Teledoc is the expansion of telehealth services within the Medicare Advantage plans, which cover about 25 million Americans. Teledoc sees this as a huge multi-year large-scale growth opportunity and has been making significant investments in its platform in the form of regulatory compliance, network construction, product optimization, and other areas to get ready for this opportunity. So we covered United, we covered CVS, we covered a government payer. Finally, last but not least, Teledoc is an M&A machine. They have driven a lot of their growth over the years through M&A. I'm not going to go into every deal they've done. And frankly, we could easily do an entire report and episode just on Teladoc's M&A deals, which maybe we'll do if anyone's interested. Please let me know. But some of the notable names they have acquired include Medicine Direct, which is a French company they acquired in 2019. They acquired Advanced Medical for just over $350 million in 2018. They acquired Best Doctors for nearly $450 million in 2017. They acquired Healthiest You for $145 million in 2016. They acquired BetterHelp for $4.3 million. I think that amount might surprise some people. They also acquired Ameridoc for $17 million in 2014, and there are many others that, like I said, would take far too long to detail here. I suspect Teledoc will continue to be very active on the M&A front. They have a great balance sheet. They're very well positioned to make acquisitions, leveraging numerous sources of capital from cash to debt and equity, et cetera. So I expect them to continue to do deals. Now, let's talk about the exciting stuff. Let's dig into the valuation. In my analysis and what I see in most of the equity research analysts' reports, it's pretty common to compare Teladoc mostly to healthcare IT companies. Some of the analysts comp Teladoc to other disruptive healthcare peers, which we've used that set before in other analysis. But honestly, the relevant ones from that list show up on the healthcare IT list as well. So I'm not too bent about which comp set you want to use. You're going to come out to about the same analysis. Some people comp them to SaaS companies, which I'm sure is fine. But for me, I'm using the healthcare IT comps. The healthcare IT comps for Teledoc include Viva Systems, Livongo, Health Equity, eHealth, Tabula Rasa Healthcare, Health Catalyst, Benefit Focus, and Vocera Communications. As a group, they traded an average of 8.7 times 2020 revenue and just about 30 times 2020 EBITDA. Most of these companies are very much still high growth businesses with an average 2019 to 2020 annual growth rate of almost 25%. So this group definitely trades on forward revenue. And that's where we see the tightest shot group, if you want to call it that, of multiples between Livongo, Teledoc, Viva, and the others, all leading the way in the 15 to 20x revenue ballpark. So what is Teledoc worth? Should the stock really be at $201, almost $202 per share, which is up 3x in just under a year? Everybody's looking at the headline numbers. There's a huge bump in medical visits in Q1. The stock is shooting up because telehealth is the new buzzword in the era of COVID-19. In Q2, Teledoc ended up with about 2 million medical visits. Then they provided guidance on their earnings call after the quarter of 2.3 to 2.4 million visits for Q2 and a total of 8 to 9 million visits for the year. The CEO said in the Q1 call that this guidance assumes their recent surge of visit volume subsides as the $0 copays for some new users expire and as shelter-in-place orders are lifted. But remains to be seen if this stays true with the way things are developing in recent weeks. So, users and usage are up. I got it. But are they making money on these people? Clearly, the markets are pricing the revenue as the stock is trading on revenue growth and even more so on user growth. However, at some point, considering equity owners only own whatever cash flow is left over after everyone else is paid, the value of the cash flow is going to matter, and this is where profitability comes into my analysis. There's no doubt that user growth and visits are surging. But during the same period, when visits grew by over 90%, revenue only grew by 41%. That's a great revenue growth number, but doesn't match user growth. The company recently guided analysts to expect total visits this year to be about 50% more than their original estimates, but only raised their revenue guidance up to $110 million for the year, which is only a 15% bump. It's clear that user growth isn't translating directly into revenue, and company management knows it. However, the buyers of the stock just don't seem to care. During this same time period, when revenue guidance was bumped upward by 15%, EBITDA guidance was adjusted from $65 million to $75 million, an increase of about 15% as well. I know the stock trades mostly on revenue growth and revenue estimates. And on an NTM revenue multiple basis, we've seen that multiple trade up from about 7x revenue a year ago to over 17 times revenue today. But for a moment, let's consider the valuation on an EBITDA multiple basis. As of today, based on 2020 consensus EBITDA estimates of $76 million, the company trades at over 200 times 2020 EBITDA. To put that in perspective, the healthcare IT peers, who seem to mostly trade on a revenue basis, only trades at about 30 times EBITDA, which is still inflated due to low EBITDA estimates and a focus on revenue growth. But that's, still not even in the ballpark of 200 times. So what does this mean? To me, it means one of three things is true. The stock is overvalued, may or may not be true. The estimates are wrong. This could definitely be true. Or healthcare IT companies are going to see astronomical multiple expansion. And look, if the Fed keeps printing money the way that it is, anything can happen, and it is happening. I think the stock is overvalued on telehealth hype. I don't think as many people will be using telehealth post-COVID as everyone thinks. And I don't think Teladoc can sustain a 200x EBITDA multiple. Either the earnings will catch up, which could take quite some time based on what company management has said, or the stock price could come down. However, if you're out there about to buy puts or short the stock, let me give you a little bit of advice that an old Wall Street friend told me once. The market can stay insane far longer than you can stay solvent. This same person also told me never trade anything that you can't ski down, meaning looking at the stock price chart. And when I look at the volatility in the stock price and the valuation trends around Teledoc, I remember why I don't do moguls. So look, maybe my opinion isn't really that valid since I'm unwilling to place a bet either way. So take it with a grain of salt. I know it sounds like I'm being negative, and I am to some degree, but I also want to be very clear that not all of this growth and the run-up in valuation are attributable to COVID and the public's newly found love affair with all things remote. As I mentioned earlier, Teledoc started to separate itself on a valuation multiple basis from its peer group in October as the UnitedHealth contract expanded. They started to prove out their ability to grow these deep relationships with partners like United and CVS and others back then. And I don't want to take that away from them. A lot of their multiple expansion is due to their own amazing efforts to position and grow their business. But look, 200x EBITDA just seems a little strange to me. I don't doubt the company's ability to keep driving top line growth, but I need to see a lot more by way of doing it profitably. Maybe they can do it. They clearly know more than I do. But if that was going to happen anytime soon, I'd expect to see that EBITDA guidance come up a bit more when they jack up those users and revenue estimates. I can say one thing for sure. If I was the CEO of Teledoc, I'd be issuing equity and I'd be using my stock to acquire companies every chance I get. What an incredible currency they have right now. Okay, so what? There's a lot we can take away here from what we're learning about Teledoc. Of course, there's the obvious stuff like the trend toward the increase in telehealth and usage increases and demand for virtual care. And we see that trend across a lot of data sources and a lot of businesses in the virtual care space. As an investor in behavioral health startups and speaking to a lot of digital health startup founders on a weekly basis, I would say you should internalize two things here. Number one, know why and how the market prices Teladoc's growth the way it does, and how you can position your company in a way that makes investors value your growth the same way. And number two, you may be wondering, how do you position your company in such a way? And you're in luck. Go download the Teledoc March 5th, 2020 Investor Day presentation. It's 140 pages of detailed explanation of their business, how they built it, how they're planning to grow, the specifics around acquisitions, business units, margins, user growth, and a whole lot more. This is a digital health startup founder's goldmine of positioning content. I've really never seen such a thorough overview provided publicly at an investor day of a business. If you are a startup in the digital health space and you aren't 100% sure your messaging is resonating with investors, customers, users, payers, or anyone else, go download this deck and lean on how they do it because their message is definitely working. You can see it in the stock price. This deck is a goldmine. I said that before. Every founder in the digital health space could find a way to leverage it or the data within it. You certainly don't want to be going into an investor meeting without knowing what's in there because I can promise you the investors do know what's in there. Okay, let's wrap things up. That's it for this week's mental health market update. To our listeners, thank you for being here. And please, if you like the content, hook us up with a subscribe or a like or a review on your podcast platform of choice and share us with a friend. We also have a Patreon account. I plugged it earlier. This is where our loyal supporters can support our content creation, which will be linked in the show notes. To the founders out there, don't forget to join the Mental Health Startup Slack community. You can find a link in the show notes. And most importantly, we want to hear from you. Please do comment on social media. Let us know what you liked or didn't like, what you agreed with or what you disagreed with. You can reach out to us on Twitter at StigmaCast, on Instagram at Stigma Podcast. You can email us info@stigmapodcast.com, and you can find us on our website at stigmapodcast.com. Thank you again for being here. That's it. Until next time, stay safe, be well, and thank you for your support.